In January 2026, gold printed a level that should not exist in a cooling inflation world. Trading screens flashed an intramonth extreme near 5,608 per ounce. And it happened while the public conversation was drifting toward relief, not alarm. They said a setup like this could never happen anymore, not with modern central banks, not with sophisticated markets, not with transparent data. But here's what makes it feel impossible. At the same time gold was acting like a fire alarm, the dominant expectation for the next inflation update looked tame. A market bracing for a CPI number around the mid-twos is not a market that, on paper, should be paying a premium for a metal that yields nothing. The common logic says high yields pull money away from gold. The common logic says falling inflation reduces the need for gold. The common logic says a calm narrative should produce calm pricing. And yet the pricing was anything but calm. Here's the uncomfortable part. Institutions already positioned for the move before most people even noticed the contradiction. That's not a conspiracy. That's a structural advantage. They live inside the plumbing. They see funding strains, collateral preferences, settlement frictions, and hedging demand long before it becomes a headline. When a dealer's balance sheet tightens, when a clearinghouse changes risk parameters, when a sovereign reserve manager quietly diversifies, those are not social media moments. Those are early signals. And when those signals cluster, price tends to move first and explanations tend to arrive later. And when gold rises while real yields stay high, it's rarely a story about a single CPI print. What I'm about to lay out changes how you interpret every inflation debate you've heard this year. The real setup is gold versus the story inflation tells, and the story the market tells back. And once you see that difference, the last month stops looking like chaos and starts looking like a familiar playbook. Welcome to Signal Ledger, where we decode what matters before it becomes everyone's talking point. If you like analysis that follows the data instead of the noise, stick around. Think of subscribing the way you'd keep listening to that calm, wise elder who notices patterns before the crowd does. And drop a comment with where you're watching from, because these signals look different depending on where you live and what your local prices actually feel like. Now, let's start with the event, because the timing is the giveaway. 5% on core. That's not a panic print. That's the kind of number that supports the idea that inflation is bending back toward normal. And yet, gold was not behaving like a market that believed normal was returning. Gold was already elevated around 4,170 per ounce in the days surrounding that release window, and it had just proven it could sprint to much higher levels in January. In a normal playbook, positive real yields make it harder for gold to shine. When investors can earn a meaningful inflation-adjusted return in government-linked instruments, the opportunity cost of holding a non-yielding metal rises. That's Finance 101. The problem is, the real world doesn't always obey the textbook, especially when the textbook assumes trust is stable and liquidity is always there when you need it. The abnormality showed up in the pacing. Gold didn't climb like a sleepy long-term allocation shift. It behaved like a market absorbing new information under time pressure. You could see it in the way price jumped through levels that usually act like speed bumps, in the way dips were bought quickly, and in the way volatility became part of the message. When gold is quiet, it's often just sitting in portfolios. When gold becomes loud, it's usually being used. At the same time, the paper side of the gold market looked like a storm system forming. COMEX open interest sat near 403,917 contracts as of February 12, 2026. An estimated volume that day ran around 178,099 contracts. That matters because paper positioning can reprice gold faster than physical metal, can move across oceans or out of vaults. So what's the central mystery? If inflation is cooling, why would gold be screaming? If real yields are high, why would gold be acting like they're collapsing? And if the public narrative says risk is easing, why do the players who manage national reserves keep accumulating metal as if the future is less certain than the headlines? The crisis, in this case, isn't a single crash or a single headline. The crisis is the gap between what markets are priced to believe and what markets are priced to fear. And that gap tends to widen right before it forces a reset. This isn't the first time the market has run this script. In fact, you can spot the pattern by looking at a few years where the official story lagged the real stress. In 1973 and 1974, inflation shocks hit alongside energy turmoil, and gold began reasserting itself as a monetary barometer. Then, in 1979 and 1980, inflation became impossible to ignore, and gold responded with a historic surge as the currency story frayed. Result, when policy tightened brutally and credibility was rebuilt through pain, gold eventually rolled over. The lesson was that gold reacts to credibility before it reacts to comfort, and credibility is fragile when a system is forced to choose between growth, stability, and purchasing power. In 1999 and 2000, the market believed in a new era of stability and productivity. Inflation wasn't the fear. But gold had spent years quietly bottoming, while confidence concentrated in paper wealth and equity narratives. Result: in the early 2000s, as the cycle turned and as policy began a long series of interventions, gold started a multi-year climb. The setup was the system leaned hard on promises, and the price of those promises began to change. Official inflation measures didn't initially capture the fear people felt, because the fear was about the integrity of the system, not the price of a basket of goods. Gold dipped in the first phase as everything was sold to raise dollars, then turned and climbed. Through 2009, 2010, and into 2011, as central bank responses exploded balance sheets and as trust in paper claims was questioned in real time. Result: gold became a referendum on the policy response, not just on prices at the grocery store. And then there's 2020 into 2022. When the world shut down, the initial story was deflationary shock. Then stimulus, supply constraints, and reopening created inflation pressure. Gold ran hard in the early phase, then chopped as rates rose. The memory that era's left behind is still present. Prices can jump faster than wages, and supply can break in ways models didn't predict. Once people learn that, trust doesn't reset the moment CPI ticks down a few tenths. Result: even as the headline numbers improved, the psychology of inflation stayed sticky, and gold kept behaving like a hedge against that stickiness. Now we get to the players, because this is where the setup becomes visible. Start with the central banks. 3 tons of gold in 2025. Poland alone was reported at about 102 tons. That's not a retail trend. That's not a meme trade. That's a policy signal. Central banks buy for reasons that don't show up in a daily price chart. Reserve diversification, settlement resilience, and assets that aren't somebody else's liability. When a central bank buys gold, it's not chasing momentum. It's restructuring the foundation of its balance sheet. Then come the sovereign wealth funds and official institutions that don't announce every move. They often use intermediaries, staggered transactions, and long timelines. Their goal is to make a national balance sheet more robust against scenarios that markets don't like to price until they have to. In other words, their buying is about regime risk, not daily volatility. Then you have the bullion banks and dealers who make the derivatives markets function. They care about margin, liquidity, and the mechanics of how paper claims translate into delivery obligations. When open interest is heavy and price is moving, the margin system becomes the heartbeat. Raise margin requirements, and you can force liquidations. Lower them, and you can encourage leverage. Either way, the paper market can become a lever that amplifies moves far beyond what physical flows would suggest. Exchanges and clearinghouses sit in the middle as referees, and they adjust risk models when volatility changes. That can mean higher initial margin, higher maintenance margin, tighter collateral rules, or changes in eligible collateral types. To a normal person, that sounds technical. To a leveraged participant, it's existential. A single margin change can turn a position into a problem overnight because it demands cash or collateral immediately. And when cash is scarce, people sell what they can, not what they want to. Finally, there's the macro layer. Central banks setting policy expectations, treasuries issuing debt, and regulators shaping how banks hold assets. The market listens to forward guidance, to auction schedules, to the pace of balance sheet reduction, and to the stress signals embedded in funding markets. Coordination doesn't require a secret plan. It happens because these systems are linked. A CPI print influences rate expectations. Rate expectations influence bond yields. Bond yields influence collateral values. Collateral values influence leverage capacity. Leverage capacity influences price. And in the middle of that chain sits gold, absorbing the pressure. And that mechanism is exactly why gold can surge even when the narrative says inflation is calming. Because gold isn't only reacting to inflation, it's reacting to the machine that responds to inflation. Now, the dislocation is the heart of the story, and it shows up in at least 3 places. First, the real yield signal, 49%. That's a strong positive real yield. In theory, that should be a headwind for gold. It means markets are being paid to hold inflation-protected, government-linked instruments in real terms. In theory, that's the kind of environment where gold should struggle because the math says you can earn a real return elsewhere. Second, gold itself. Trading like real yields are not the only variable that matters. A metal pressing toward January's extreme and holding levels that imply a different kind of risk is being priced. When those 2 signals diverge, it's not random. It's a message. It says the market is treating real yield as less certain than the number suggests, or it says the market is pricing risks that tips don't fully hedge, like currency concentration risk, settlement risk, or the risk of policy reaction functions changing in a hurry. Third, the paper versus physical tension. Paper markets can trade enormous notional amounts of gold with contracts that never result in delivery. That's normal. But the bigger the paper arena becomes, the more it relies on confidence that positions can be rolled, netted, and settled smoothly. When that confidence wobbles, participants demand better collateral, faster settlement, or actual delivery. And those demands, even from a small minority of participants, can stress a system built for netting rather than for mass delivery. You also see a geographic dislocation. Demand for physical metal can surge in one region while paper pricing is driven in another. When the price mechanism is dominated by futures flows, it can underreact to physical tightness until tightness becomes unavoidable. That's why you sometimes get sudden repricings that feel like they came from nowhere. They didn't. They came from a backlog of reality catching up. CPI is standardized and important, but it can lag the stress people feel if essentials rise faster than the overall basket, or if the cost of living shifts through housing, insurance, and services in ways that don't feel linear. When lived inflation remains uncomfortable even as the headline cools, trust doesn't snap back to normal. It stays bruised. Gold responds more to bruised trust than to a single data point. This is the part no one is discussing cleanly. Gold is not only an inflation hedge. It is a hedge against the gap between the measured story and the lived reality, and against the policy response to that gap. So let's walk through the mechanism in plain language, because this is where the setup becomes obvious. Imagine a stadium where the tickets are promises. Most of the time, people trade tickets back and forth, and only a fraction of them actually walk through the gate. That's efficient. It keeps the system liquid. But it also means the whole system depends on the idea that if someone wants to walk through the gate will open and the seats will exist. The paper gold market is similar. A large number of contracts represent claims that can be closed, rolled, or settled without delivery. That's normal. The issue arises when volatility increases and when collateral becomes more valuable than yield. In those moments, the market stops caring only about price and starts caring about settlement. Now add margin to the story. Margin is the security deposit for holding a futures position. When volatility rises, the exchange and clearing members may require a bigger deposit. If you are leveraged and you don't have extra cash, you have to reduce your position. That reduction is a forced sale, not an opinion. Multiply that across thousands of participants, and you get sudden waves of selling or buying that have nothing to do with long-term valuation. Here's where it gets interesting. Forced selling can hit even in a bull move because hedges and short positions can be squeezed. Dealers who are short futures to hedge physical exposure might need to buy to maintain hedges as volatility changes. Funds that are long might be forced to trim if margin rises. Meanwhile, official and long-term buyers can use those forced flows as liquidity to accumulate because they are not operating under the same leverage constraints. This is why the setup can look like a paradox. Gold can spike, dip, and spike again, not because the story changes every hour, but because the market is digesting stress through its plumbing. The headline narrative moves slowly. The collateral system moves fast. Now connect that to real yields. A quoted TIPS yield is a market number, but it assumes a particular liquidity environment, a particular policy regime, and a particular confidence in measurement. If the market begins to question any of those assumptions, the opportunity cost logic weakens. At that point, gold's role shifts from non-yielding asset to unencumbered collateral, and that changes demand in ways that don't show up in CPI. So when gold is firm while real yields are high, it can mean the market is paying for something other than inflation protection. It can mean the market is paying for independence from the collateral stack. That's the mechanism people miss. Let's put proof on the table with numbers, not vibes, and then connect them to what they imply. 3 tons in 2025 is a structural demand source. Poland's roughly 102 tons is a clear example of how a single institution can move the needle. That is official accumulation during a period when many commentators insisted gold was less relevant because yields were up. The contradiction is visible right there. Policy institutions buying hard assets while public narratives lean toward normalization. 49% on the 10-year TIPS yield. If you've watched gold for years, you know periods of rising real yields often coincide with pressure on gold. So when gold is elevated anyway, it suggests something is overpowering the classic relationship. That something can be diversification away from currency concentration. It can be collateral preference. It can be a desire to own assets not tied to another party's promise. And it can be hedging against policy volatility. Now the paper side, 409 open contracts and roughly 178,099 contracts trading in a single day. That implies heavy participation in a large arena where small shifts in margin and volatility can cause forced behavior. It also implies that price discovery is being driven in an environment where the speed of decision-making is high. When that arena tilts, it can reprice gold faster than most people can process. Finally, connect it to timing. Going into a CPI release window like February 13th, 2026, institutions treat the data as a liquidity event. If they're already positioned, they use the event to confirm, to add, or to reduce. The surprise isn't the number. The surprise is how positioning interacts with the number. So what does this mean forward without turning it into a prediction? Historically, when gold rises, despite high real yields and a calming inflation narrative, it's an early warning that the market is repricing confidence. Not panic, not apocalypse. Confidence in policy, confidence in currency stability, confidence in the idea that the future will look like the recent past. If the divergence continues, there are a few scenarios that tend to appear. The conservative scenario is that inflation readings soften, growth cools, and real yields drift down from high levels. In that world, gold's strength looks less mysterious and more like a head start on a friendlier rate backdrop. The moderate scenario is that inflation stays sticky in key areas, policy remains tight, and financial conditions strain in pockets, pushing investors to diversify into hard collateral even while real yields remain positive. The aggressive scenario is that a confidence shock hits, and the market reprices what it considers safe faster than official narratives can adjust. Notice what ties those scenarios together. It's not a guaranteed outcome. It's the principle that gold responds to regime shifts, and regime shifts reveal themselves first through dislocations, not through headlines. So what should you watch, objectively? Watch the behavior of real yields versus gold. Watch whether central bank accumulation remains elevated relative to pre-2020 norms. Watch futures positioning, volatility, and any abrupt changes in margin policy that can force liquidations. Watch the spread between what inflation measures say and what consumer and business surveys imply about pricing power. And watch whether the market begins to treat safety as a function of collateral quality rather than yield. Now we come to the divide, because this is where outcomes separate. The split is not between smart people and not smart people. It's between those who track narratives and those who track signals. Narratives are designed to feel coherent. Signals are often messy, contradictory, and early. They'll wait for a neat explanation, a single cause, a clean headline that makes it all make sense. And by the time that headline arrives, the big positioning has already happened. The information gap becomes a wealth gap, not because anyone is evil, but because the structure rewards those who understand the plumbing. Those who catch the setup look at the same screen and see a different message. They see central banks accumulating hundreds of tons in a single year. They see a positive real yield environment that should suppress gold, yet doesn't. They see heavy paper market activity that can accelerate repricing. And they recognize the oldest market truth. Institutions move first, and retail explains later. And one more thing to hold on to. Dislocations don't resolve gently. They resolve through repricing, through policy shifts, or through stress that forces someone to accept a worse deal than they planned. When gold is the asset refusing to agree with the all-clear narrative, it's often because the market is prepaying for that resolution. Watch for moments when bonds, currencies, and commodities stop telling the same story. That's when the setup becomes an event, and when the crowd finally asks why. By then, the move is usually already half finished because the signal always appears before the public explanation. That's the setup in plain sight. This is signal ledger, where we decode what matters before its headlines. If this connected dots you hadn't put together, you know what to do. Because the question isn't whether the setup unfolds. The question is whether you recognize it while it's still a setup.